If your credit utilization is over 30%, you're in big trouble. In today's video, I'm going to show you some simple credit hacks that you can use today to help hide or lower your credit utilization. In fact, everything that I'm sharing with you in this video is something that I've done myself and has helped me get a credit score over 800. Stick around to the very end and I'll give you a free little gift to help you with your credit journey. When it comes to credit card debt is one of the biggest factors affecting your score. The amounts owed portion of your FICO credit score makes up 30%. Which is the second largest factor. Now, the golden rule is to keep your credit utilization under 30%. The reason why it is 30% because this is the average utilization that is recommended. But based on FICO guidelines, they suggest keeping your credit utilization anywhere between 1 to 6%. Personally, I think it is easier to aim for under 10%, but if you can keep it closer to zero, that's ideal, but I understand that it may not be possible for everyone. So the first way to hide your utilization is by shifting your personal debt into business debt. Now, I know that there are plenty of business owners out there that still put business expenses on their personal credit cards. Even if you're not a business owner yet, there are plenty of business credit cards out there that offer 0% APR on balance transfers. The thing about business credit is that it is generally not reported to the personal credit bureaus. So whatever that you put on business credit cards or take out a business loan, generally, it does not affect your personal credit. By shifting personal credit card debt into business credit cards, this is one way to hide your credit utilization until you're able to pay it off or qualify for better loans to pay off the debt faster. Now, if you don't have access to business credit cards, it is very easy to get started. Anyone can become a business, and I've made videos on this topic before, so feel free to check them out up here. But if you don't want to apply for any business credit cards, you can still manage your balances by shifting them between your personal credit cards. This will only work if you have more than one credit card. If you have only one, then you're kind of just stuck with that balance. But most likely the people who are watching this video have a few cards. When it comes to how your credit utilization is calculated, FICO looks at both the utilization on each individual credit card and the overall utilization across all of your accounts. Let's just say that you have 3 cards with each having a $5,000 credit limit. If one of the cards is maxed out and the other 2 have 0 balances, then you would want to balance things out. You can shift the balance from the maxed out card evenly across all 3. So in this example, you should aim for around $1,600 on each card. From a credit scoring perspective, this can improve your score and make you look better to underwriters. One thing to note is that balance transfers are generally not free. Sometimes they are, depending on the credit union or bank, but most of the time there is a 3% fee on transferred balances. This is where you need to weigh the pros and cons and decide whether or not it is worth it. Now, another strategy that you can use to lower your credit utilization is by simply asking for a credit limit increase. Depending on your credit profile and your relationship to certain lenders, this might be challenging if all of your credit cards are maxed out. This strategy works best when your utilization is lower and you have a decent credit score. The thing is that it never hurts to ask. There are plenty of issuers out there that allows you to request for a credit limit increase with only a soft inquiry, meaning that it won't hurt your credit. And you won't know if you'll get a higher limit unless yes. The next strategy to lower or higher credit utilization is by using a method called velocity banking. So in a nutshell, it involves putting all of your income towards paying off your credit card debt, then putting any other expenses back on that card. By timing it correctly, you can lower your credit utilization when it reports to the credit bureau. So the goal is to keep the statement balance as low as possible before it reports. So for the next 30 days, your credit score will actually look better than it actually is. As you add expenses to your credit card, since you have expenses to cover, your debt on this card will grow again, then this is where you would have to repeat that cycle. Now let's move on to the next method, which is by transferring your credit card debt, which is a revolving line of credit, into a loan, which is an installment line of credit. The way to do this is by getting a personal loan or a debt consolidation loan, then using those funds to pay off your credit card debt. This doesn't eliminate your debt, it just simply transforms it into another type of debt. But typically, loans come with lower interest rates than credit cards. These type of loans also affect your credit score differently than it does credit card debt. Credit card debt plays a bigger role in your overall credit score compared to installment lines of credit like a loan. A loan has a predictable payment schedule every month until it's paid off. On the other hand, credit card balances fluctuate and they can go up or down depending on what expenses that you charge to the card. So if you're able, I would recommend looking into some of the loan options. A site like Bankrate can help you see your odds of being a good candidate for certain loans. So since you are looking for ways to lower your credit utilization or minimize its impact on your credit score, let's talk about some other strategies that you can use right now to improve your score. These will help you get approved for other credit cards or even loans to offset some of your debt. Now, one thing that you can do is to get added on as an authorized user. You can usually do this by two routes. First is by getting added on by a family member or someone who trusts you. However, it can be a tough sell to ask someone to add you onto their account. I think the easiest approach is by letting the original account holder hold onto the credit card so they have the peace of mind knowing that you won't rack up a lot of debt on their account. After all, the original account holder is responsible for all debt charged to that account. The second way is by buying trade lines. Essentially, you are just buying a slot onto someone else's account, but these don't last forever though. Once you buy a trade line, it gets reported to the credit bureaus and it stays on your report 1 to 2 months before they actually remove you from their account. So you really have to time it correctly to get the most impact. Of course, you still have the history from that account on your credit profile for up to 10 years, but you will have a bigger impact while the account is still open. Another way to lower your credit utilization is by getting secured loans based on your assets. If you own a home or have some equity, you can get a HELOC, which is a home equity line of credit. Some fintech companies will make this process easier, like the Avon card, but you can also go for a traditional HELOC from your lender or credit union. You can also use these funds to pay off high interest credit card debt. In addition, if you own your car outright, you may be able to get a secure loan based on the title of the vehicle. This means that you will have an auto loan and the lender will have a lien on your title. But it is worth shopping around since interest rates may be better than what you're paying on your credit cards. Another option is a margin loan. Some online brokerages offer this. For example, if you're an investor using something like M1 Finance, they allow you to borrow against your portfolio at an interest rate that's likely lower than your credit card. This can be an alternative strategy to pay off credit card debt and shift your utilization to paying back the margin loan. The thing is that margin loans isn't reported to the credit bureaus, so this can positively affect your credit by making it look like you don't have any debt. Another thing that you can do to put yourself in a better position to get a personal loan or a debt consolidation loan is to use your network or partner up with someone who can co-sign for that loan. Now, this is definitely a hard ask. The only people who might consider this are family members or really close relatives. The reason why it is tough is because the co-signer will also be responsible for the debt and it will be reported to their credit report as well. Plus, their credit will be pulled and they will be responsible if you can't make any payments. So while this option is challenging, I just wanted to put it out there because it is a possibility. Fintech credit lines are another option that can help you manage your credit card debt or at least lower the interest rate that you're currently paying. There are a few companies in the space, but probably the most popular is Goss Money, and I think that's pretty much how you pronounce it, but this is how it works. Goss connects your credit cards via Plaid, a third-party service provider that connects credit cards and checking accounts to other fintech platforms. They will then run a soft credit check to see if you're eligible, and if you are, you can pay off your credit cards using their credit line. You can then use your cards as normal, but you would just repay Goss directly once a month. This is kind of similar to a debt consolidation loan, but from my understanding, they are transferring your credit card debt to a lower APR credit line and then you pay off Goss directly. It's basically an all-in-one app that allows you to keep track of your payments, lower your APR, and speed up the process of paying off debt. One thing to note is that this service isn't free. They have a membership fee that starts at $4.99 a month, but you can cancel it at any time that you want. So you need to run the numbers to see if the difference in APR saves you more money than the membership cost. When your credit is good and your utilization is low, most people don't think about working on their credit. I personally think this is the best time to work on it because this is when your credit tends to be the strongest. So if you were to think your credit like in seasons, there are times to work on it, then there are times to use it. Similar to farming. There are times where you plant seeds and there are times when you harvest the fruits of your labor. Your credit is no different. So when your credit is good and your utilization is low, that's when you should try to increase your credit limits as much as you can. The reason for this is that you can carry a balance and it'll have less of an impact on your overall utilization. If there is one key takeaway that you can take from this video, is that you should focus more on business credit, mainly because it doesn't affect your personal credit. Try to keep your credit utilization between 1 to 6%, and if you want to keep things simple, just try to keep it under 10. Now, if you have any other credit issues aside from credit utilization, I recommend checking out my free credit community called the Credit Collective. I offer free resources there to help you get your credit on track, so check it out. It's linked right up here, and if you want to hang out with me some more, check out these videos over here.